Good morning, everyone. It's good to see so many friends here. I am Babak Abbasa, the CEO of the Toronto Centre. Welcome to this timely discussion on climate change and its relationship to financial stability. The challenge before this distinguished panel is to help bring these two global policy preoccupations together and to advance the conversation around what regulators and supervisors need to do to protect financial systems, investors, and the greater public against climate-related risk, and how to facilitate policy instruments and responses. This discussion is important to Toronto Centre because it can advance our mission to promote change that would lead to sound, stable, and inclusive financial systems, which in turn foster economic growth and poverty reduction. I would like to acknowledge Toronto Centre's key sponsors, Global Affairs Canada and the IMF, as well as the World Bank Group and the Swedish SIDA. Now, without further ado, it is my privilege to introduce the Honourable Catherine Mckenna, who will deliver opening remarks. Minister Mckenna was elected to Canada's Parliament last October and was appointed by Prime Minister Justin Trudeau as Canada's first Minister of Environment and Climate Change. Before entering politics, she had a long record of contributions and accomplishments in public life. A few highlights are, she has practiced law at leading firms focusing on international trade, competition, investment, and constitutional issues. She co-founded and led Canadian Lawyers Abroad, a charitable organization that engages in the areas of good governance, rule of law, environmental issues, and human rights. She was senior negotiator with the UN in East Timor, which culminated in the Timor Sea Treaty. She taught at the University of Toronto's Monk School of Global Affairs. Since her appointment, Minister Mckenna has been a star in Prime Minister Trudeau's cabinet and received praise for her strong contributions at the Paris Climate Conference, where she was one of the key international facilitators who helped achieve global consensus on the Accord. Minister Mckenna's indefatigable leadership has finally put Canada on the world stage as a key player in the climate change deliberations. Please join me in giving her a warm welcome.
Thank you very much, Babak. I don't know about a star, but I will say that we are certainly working hard and very fortunate to have a Prime Minister who cares greatly about how we tackle climate change. Good morning, honoured panelists, governors, and guests. I'd really like to thank Toronto Centre for organizing today's panel on climate change and financial stability. Since its creation in 1998, the Government of Canada has been a strong supporter of Toronto Centre's work, training financial system regulators and supervisors around the world. I'm very proud of the leadership Toronto Centre is demonstrating by facilitating really important conversations like the one we're having today. Last December, very shortly after being elected and appointed as Minister of Environment and Climate Change, I had the great privilege of leading Canada's delegation at COP21. There we took a major step forward, as all of the world's major economies committed to the Paris Agreement. This was really an unprecedented show of global cooperation. It was very encouraging to see the passion and ingenuity with which so many people in so many countries are working to alter the course we're on and set the planet on a more sustainable path. But we all know that this is just the beginning. The real challenge is taking place now, the work to make this historic agreement a tangible achievement. For Canada, we've made climate change a major priority of our domestic and foreign policy agenda. We also strongly support the implementation of the UN's 2030 Agenda for Sustainable Development, which rightly places development and climate change together. And we're continuing to provide assistance to the most vulnerable countries, where climate change threatens to roll back decades of development gains, and where the needs are most urgent and immediate. But confronting climate change and its effects, while encouraging economic development and fighting poverty, requires significant global cooperation and innovative solutions. To get there, we will need strong market signals. I will say I'm a huge advocate for carbon pricing, and I will continue to be, because it is a critical market signal. So was the commitment we made to market mechanisms in the Paris Agreement. But how we regulate our global and national financial systems is also a very important part of our response to climate change and our efforts to support low carbon economic development globally. And that's what I want to talk about today. Pricing insurance to reflect climate risks will send the necessary market signals to stimulate low carbon investments. But we also need to figure out how to make insurance-related products available for the most vulnerable, especially given that in many cases, the most vulnerable contributed the least to greenhouse gas emissions. That is why Canada contributed $50 million to the G7 Initiative on Climate Risk Insurance last November. And we're working with the G7 and our partners to provide by 2020 about 400 million more poor people with insurance against the risks of climate change. We also need to think about how to value carbon-intensive financial assets and investment opportunities. Financial institutions and investors need to incorporate these risks into the risk assessments and stress tests that help to ensure the soundness of financial institutions and the stability of financial systems. Investors and companies that acknowledge climate risks and factor them into decisions will be far better prepared to reduce the impact of those risks and provide more competitive financial returns. They will also be doing their part to tackle climate change. While there are risks, climate change also presents many opportunities for financial sector development. There's room to create new insurance products and promote commercially sustainable insurance coverage for climate-related risks. There is a potential to expand the use of green bonds, bonds that finance projects that have positive environmental and climate benefits. There are opportunities not only for institutional investors, but also for financial institutions that generate and underwrite debt instruments. International organizations, forums, and standard setters such as the G20, the Financial Stability Board, the IMF, and the World Bank have all made assessing and mitigating the consequences of climate change on economies and financial systems a priority. They have all taken steps to account for and respond to climate change in their policy direction. And large investors get this too. Recently, a group of 120 institutional investors representing over $4.6 trillion in assets under management and that invest in the province of Alberta delivered a joint letter to Alberta Premier Rachel Notley supporting Alberta's commitment to strengthen its climate policy. These investors wrote that they see that an effective climate policy can stimulate innovation and bolster the diversification of the economy. The letter also says that phasing in an effective carbon price will substantially reduce emissions over time while giving companies the opportunity to transition and giving capital markets the opportunity to respond and allocate capital effectively. So we welcome the contributions of the Financial Stability's new task force on climate-related financial disclosures, which aims to enhance disclosure of climate-related risks in the financial sector. I'm very pleased to note that they just published their first consultative paper. Discussions like the ones we're having today are also critical to motivating, informing, and facilitating the changes that need to be made. And it is my very strong view that Canadian companies are better positioned than ever before to address climate risks and seize the economic opportunities of the future. On behalf of the Government of Canada, I thank you all for attending and wish you good luck. I'm looking for your solutions. I'd like to turn the podium back over to Babak. Thank you.
So, Minister, thank you very much for those broad comments. For the audience, the last time you'll see me on the stage, I'm just here to now, at this point, introduce Aditya Narain, our very capable moderator. He has a distinguished career at the Reserve Bank of India, as well as having worked here at the IMF for a long time, Deputy Director at the Monetary Capital MCM, and also the head of the technical training, as well as the member of the Board of Directors of the Toronto Centre. I also like to point out that Governor Stéphane Ingves chair of the Basel Committee, has been a member of the board of directors of the Toronto Centre since the year 2000. A couple of very formidable people in the audience. I can't point all of them, but Monique Smith from the Canadian Embassy and our previous board members are all here. So thank you again. It's great to have all these friends. And Aditya, it's your show.
Thank you. Thank you, Babak. First of all, I thank the Minister for her very comprehensive remarks, very encouraging remarks as well. And the good part is it's made my introductory remarks absolutely relevant. So I'm going to be able to dive straight into the discussion. I think you laid out the linkages between, the potential linkages between financial stability and climate change very well. It's an area where, particularly climate change, where both the IMF and the World Bank have done a lot of work, but more on the side of climate mitigation, climate finance, adaptation, providing fiscal policy advice on measures that could be taken by countries, pricing, taxation. And we've also done a lot of work on the financial stability side separately. And Stefan, who's here under his leadership in the Monetary and Capital Markets Department in early 2000s, had laid out the financial stability framework, which we even use today for our assessment of financial stability frameworks and providing the right policy advice to our members. But we haven't been looking at the interlinkages between the two till very recently. And when we started, we discovered that while there was a lot of interest in the subject and trying to understand what these linkages might be, it was still an area where it's very difficult to actually map out beyond the very direct references to insurance, for instance, as to how the financial sector might play a greater role. Now, it's true that the financial sector has a role both in, as it's referred, scaling up the green, as also in managing, as it's been referred again, managing the brown, which is managing the impact and implications of climate change. And there has been a lot of work in moving forward with the green agenda in the financial system. There are lots of products which have been developed in this regard. There have also been innovative risk transfer sharing and pooling mechanisms which have been laid out. But the market for this is still very young in a certain sense, and there's a lot of maturity which is needed in these markets, as well as providing a perspective for regulation to be able to absorb these developments. So I'm not the expert on climate change at all. So I'm not going to try and even lay out any more of these issues, but I'm going to turn to the people who actually know what they're talking about. And let me start, first of all, with Dinor. And Dinor, you have been an advisor to the UN Secretary General. You have advised world leaders on the topic of climate change. You are also now the Dean of Public Policy, the Public Policy School at the University of Maryland. So you are preparing a whole new generation of people to take on the role of climate change advocates and specialists. So it would be great if you could lay out for this audience, and I can see from many faces I know here that a majority of the folks here are more conversant with financial stability issues. If you could lay out the context of these discussions, also a little bit about what has been achieved since Paris, what it means for financial sector policymakers, and essentially what lies ahead.
I can do that in 3 minutes now. Thank you very much for the invitation to join you all today. I love the fact that we really are joining two communities here this morning. For those of you coming from the financial stability side of the equation, you may not see people like me very often on the climate side, and vice versa. This conversation is long, long overdue. I would simply start by saying, for those of you who are only familiar with the Paris Agreement from a couple headlines in the paper, this agreement that was struck last December by the leaders of the world is not only a new climate agreement, it is a new kind of climate agreement. It is a fundamental discontinuity in this issue, and a positive discontinuity. This agreement, and I would like to support the description of the minister as having played an important part in facilitating this, we saw a new kind of politics emerge in Paris. This is a very ambitious agreement. The commitments made by governments surpass anything done before, but there is still a gap between the commitments on the table from all the different governments of the world and what will need to happen to meet the agreement on the very ambitious goals set out in the agreement. But I say it's a different kind of agreement, not just because of its level of ambition, but because it encompasses a full range of actors, not just the governments. This is not your grandfathers, grandmothers, or even your parents' kind of climate agreement. It encompasses a range of actors, private actors, that in previous agreements were very much literally locked outside the chambers when they were struck. So we are talking about the interactions between government policy making at all levels, not just national governments, but state and local, the whole new set of players in there. The private actors on the private financing side, but also the companies. And what you see is a set of feedback loops that are very volatile in some cases, but now we have a potential to really get change at scale and at a pace we haven't seen before. One other thing that's very important about the Paris Agreement is that it does not stand alone. Last year, there were 3 major international agreements struck that bear upon this space. The Paris Agreement is, of course, maybe the most high profile and the newest in many ways. But the agreement last September for the Agenda 2030, the new development agenda, is quite fundamental, and it cuts across all sectors and bears on the overall development equation that climate features in the agreement, but cross-cuts the entire development agreement. There was also another agreement, international agreement last year in Sendai on let's call them the geographic and geography risks on the planet. And so mitigating the natural disasters and preparing for those is one set of risks that we need to talk about, and Sendai addresses a global framework for that. Mitigating other kinds of risks, including the transition risks of how do we manage a macro development transition in the Agenda 2030. And of course, the Paris Agreement itself focuses on various types of risk. Now, the one thing I'd like to conclude with is that while many people in this room focus on risk for a living, and risk is your bread and butter, what is important about the Paris Agreement, it's not just about mitigating risks, it is all about setting up opportunities. And what we are seeing is a mass mobilization around trying to seize some of those opportunities while mitigating risks. I was recently in Houston, Texas for a meeting of the CERA Week, which is kind of a 35-year running confab of all the largest oil companies in the world. And I will tell you the number of CEOs who introduced themselves to me as we have made or are making or are about to make the transition from being an oil company to an energy company. This is the kind of tectonic shift that we're starting to see in the marketplace when major economic actors see their fundamental business model changing in a time frame that is really unprecedented. So that provides opportunities as well as risks in the marketplace. I would just conclude with one observation that I think if you read not just the business section or the finance section of the paper, but the front page, you see some interesting signals coming out even since Paris, because you asked about what's happened since Paris. Just this past week, the bankruptcy filing of Peabody, the largest coal company based in the United States, this is a piece of the tectonic shift. But these companies in Houston that are shifting their business operations in ways that are moving from fossil fuels to a broader portfolio, that's another piece. And then you also see some things that I don't think analysts foresaw at all 6 months ago, when over 300,000 Americans pre-order the new Tesla model, and then GM follows within days saying, but our cars are going to go further and faster on all electric vehicles. The pundits, the analysts kind of see a nice, slow, linear, incremental progression. I think what we're going to see is much sharper spikes on both the opportunity side, but also on the risk side, because we are talking about fundamental shifts in our economies simultaneously. So this agreement in Paris is significant. It is a flexible agreement that will evolve with time, but it sets out a direction that I think can help to shape markets and also help shape policy in the financial space as well as in the political space.
Thank you, Dino. And turning now to Governor Ingves, you bring at least 4 perspectives into the discussion, at least. You, as the chairman of the Basel Committee, which has been leading the discussions on the post-crisis regulatory reform for banks, as the governor of the Central Bank of Sweden, which is a country which has taken a very leading role, a progressive role in the environmental discussions, as a member, of course, of the board of the Toronto Centre, and as the earlier director of the Monetary and Capital Markets, who laid out the framework for financial stability analysis that we do. From your perspective, what do all these developments mean, particularly for banks and particularly for prudential regulation of banks? Because while it's been very clear what the implications might be for the insurance firms, the role of banks and what they might be expected to do is still something which is up in the air.
Well, thank you, Aditya. I think that your last remark that the thing is still up in the air is kind of a relevant one, because here the hard part is to figure out what is this and what is relevant for the financial sector, and how are we go about dealing with this. And there's still some distance between talking about climate change in general terms and breaking this down to kind of technical details in terms of how you're running a bank or how you're not supposed to run a bank. So let me make a few general remarks around this when it comes to banking, prudential regulation, and climate change. One issue that those of us who are doing this type of work are struggling with is the difference in time horizon. I deal with monetary policy. That's kind of a time horizon of a couple of years. And after 2-3 years out, nothing is there because everything is supposed to be fixed within a couple of years, end of story. If you're dealing with the financial sector issues, the time horizon is something centered around what we nowadays call the credit cycle, between, let's say, 10 to 15, 20 years, perhaps. And that's dealing with financial stability or trying to avoid financial instability in one way or the other. But of course, climate change, that's a completely different time perspective. And that, of course, that means then from a financial sector perspective that by the time you sort of recognize what is going on from a financial sector perspective, a lot has already been going on for quite a while when it comes to climate change. And that is what creates it hard when it comes to finding the proper combination of things here. Now, when it comes to prudential regulation, sometimes people have argued that you should use prudential regulation as a tool to kind of help out when it comes to avoiding too much climate change. I must say that I'm a bit worried about doing that, because then you can quite easily actually really get things wrong when it comes to dealing with financial stability. So I do think it's safer for us to deal with financial stability to stick to that, but recognize that badly managed when it comes to climate change, there are risks out there, and that can also sometimes be a problem when it comes to financial stability. One first step, which is good for everybody involved in this, is basically the G20 Financial Stability Board initiative to create more clarity when it comes to information. Because without proper information, without standardized information, that's really the key to it. Without standardized information so that you can really understand and report what is going on, it's very hard to make sense of what is going on. So from that perspective, that's a very good first, and it's a very good initiative. But without that initiative, it would be very, very hard to sort of take next steps, because then you wouldn't know what those next steps would be. So that's really, really a good thing, and I hope that we get this thing done fairly soon. And I don't really perceive that no one is really objecting to that. So better information will be a good thing for everybody. And then we'll decide what to make of it in due course. Now, looking at this from a financial sector perspective, a lot of it is, of course, dealing with risks in different ways, thinking hard about that. And it makes sense for us on the regulatory side to think about how to deal with the uncertainty. But that's not so easy either, and I'm just going to give you two quick hypothetical examples of why why this is difficult to deal with. There are probably many other relevant examples as well. And you just talked about Tesla. Let's start with two automakers. One is Tesla, and the other one is Volkswagen. Now, two very, very different perspectives, because Volkswagen didn't really behave well when it comes to environmental risks. And if you look at this from a bank's perspective, that of course makes you think about what is going on here, what happens to their profitability, are there other automakers out there doing the same thing? Does this mean that this whole part of the business has gotten riskier in one way or the other? How do I translate that into, how do I internalize that into how I think about these businesses in terms of my lending conditions, let's say, to those types of businesses? Now, that's clearly, there's clearly an environmental aspect to that. On the other hand, Tesla, that's a completely different risk. I don't think that people argue about the positive from an environmental perspective when it comes to what Tesla is doing or trying to achieve. But from a financial sector perspective, it raises a completely different set of issues compared to my Volkswagen case, because then you have to think hard about, do they have enough money in order to make this business successful? What are other automakers doing? How is this transformation going to take place? How long will it take? And what are these guys doing with my money in the meantime? And am I going to get my money back? Because that's essentially what banking is all about. So it's a topic not so easy to deal with, that raises a host of very, very different issues depending on what you look at more sort of the micro level. Awareness needs to get higher and higher. I think increased standardization in terms of information will make that happen. But at least as of now, I do think that first best when it comes to financial regulation is to really stick to financial regulation from a traditional risk perspective and not use it as a tool in order to guide credit in one direction or another.
Thank you, Governor. The Bank of England, of course, has played a very major role in the ongoing discussions on climate change and financial stability. And both as in their participation in the Financial Stability Board, where Governor Carney has led the discussions on the task force of climate-related disclosure. Also in the work which the Bank of England has done on insurance, the report which came out last September, which laid out very clearly what the risks were from climate change to financial stability. And you, Governor Cunliffe, have played a very key role in all of these discussions, both at the Bank of England as well as at the Financial Stability Board. So, and you heard the comments of both Governor Ingves and Dean Orr. Could you, for us, first of all, lay out your perspective of the interlinkages between climate change and financial stability, and what the potential channels of transmission of these risks are?
Yeah. No, thank you. I should say at the outset that the defining characteristics of the spring and annual meetings of the IMF is you hear the same thing in different accents from different people, and some have got different ways of introducing them. So you'll have heard some of this, what I'm going to say, and also people do not coordinate beforehand. So you will have heard some of this beforehand, but maybe I can just put a slightly different gloss on it. And the first thing I'd say is I think there's just been a major shift in perception around climate change and financial stability over the last year and a half. And I don't think it's to do with the bank. I mean, I'd be gratified if it were to do only with the Bank of England. But I think there's a more general perception shift. And that's how perceptions change in society and the economy when people are confronting issues. And I think you can notice that. So my first point is in the financial stability world, there is this shift. We shouldn't hide, and Stefan's been quite open about it, there is a debate about how we use the tools and whose responsibility in society is it to decide which tools are used to which instruments. And we're all very keenly aware that we're not elected and we have to be quite careful in those areas. But I think within the community, there is a shift in perception. Climate change poses many risks to society and to the economy. And from a financial stability point of view, you're not just thinking, your first attention is always to the risks being specifically generated within the financial sector itself. How are banks managing their businesses? Are they over-leveraged? Are they taking bets where they're not covered for? But financial stability goes wider than those sort of direct risks of how are the agents in the financial system managing business? Are they taking risk that they're not catering for? Because the financial system, if you think about it, sits at the centre of the economy. It intermediates savings to investment and to borrowers, and basically all economic activity which requires finance runs through the financial system. So if you get something which poses broad risks to the economy, okay, those risks will transmit into the financial system in an indirect way. And a financial stability authority, and I'm in charge of responsible for financial stability at the Bank of England, we have to think not just about what is directly happening within the system, we have to think how are things that are happening in the broader economy going to transmit through the system, and are there risks there that could destabilise the system. And the best way to explain that is to start perhaps with the work that we did on insurance in the Bank of England, and then use that as a lens just to push it out a bit. And I'll get into the disclosure task force because I think it really is important. On the insurance side, London is, UK has the third largest insurance sector in the world. The bank is the insurance supervisor. So we thought we ought to do a report on how climate affects insurance. That's the most direct and obvious link into the financial system. And the report came up, I think, with three types of risk. The first is the one that everyone thinks of automatically, physical risk. How will climate change damage property? How will it disrupt trade? And how does that go to insurance? Insurance is well used to providing catastrophe insurance, weather-related insurance. There are some difficulties here. Climate change is not just catastrophe insurance, because you're talking about changes in the probability of the distribution, changes in the correlation. So these are quite complicated things to model. But the first is the insurance industry aware of modelling properly, responding to climate change physical risk? The second risk that we identified was liability risk. Insurance companies write liability insurance, and as climate change sort of goes forward, there will be damage and people will sue. And you only have to think of tobacco, asbestos, to think about how the insurance industry picks up the liability when actually people want compensation for damage that has happened in the economy. And that can be very large and very destabilizing. And the third type of risk I think is the most interesting. It's transition risk. So insurance companies, particularly life insurers, not only issue liabilities, they hold assets against them. And those assets are stakes in the real economy, either through financial assets, bonds, equities, or sometimes direct assets like property and the like. And what they need to think about is whether those assets can be repriced if we have a regime shift on climate change. And this is really Robert's point, I think, that one tends to think of a linear progression, a smooth linear progression, and everything kind of moves forward. But actually, progress on climate change is likely, I think you used the word spiky, it's not going to move necessarily in a linear way, and that insurance companies that hold assets on their balance sheet need to understand how the underlying value of those assets can change, particularly if the public policy reaction on climate change changes or through manifestation of climate damage. And there, one obviously thinks about stranded carbon and energy companies, but it isn't just that. It's also companies' business models, how they use energy, the sources of energy they use, where they get it from. It goes quite broadly around to really the business model and the underlying proposition that that lies behind the economic activity. And I think the report concluded that insurance companies were aware of these things. They were modelling. They saw the challenges. As regulator, we need to make sure that they keep on top of that. But this last risk that I mentioned, transition risk, is actually a lens for then looking at the broader economy. Because the financial sector, as it intermediates savings and investment in the real economy is subject to transition risk. And that's why the Climate Change Disclosure Task Force is important. It isn't just, as Stefan has said, we're getting information on risks. We're actually enabling investors and the intermediaries that manage the investments and channel funds to see the risks that the underlying investments have. And in that sense, the financial sector's job is to assess risk. Different people take different views on risk, and that's a kind of normal thing of financial markets and the financial sector. But unless it has the information, unless it understands what's going to happen to the underlying asset value in different states of the world, it's quite difficult to make that assessment of risk. So the information not only enables the regulators and supervisors to understand risk, it actually enables the financial system itself to get a much better handle on that. And bluntly, it enables people to take bets. And if you believe that climate change is not going to happen and public policy is never going to react, well, then you can fill your boots with things which are subject to climate risk. And that's the way our kind of markets work. So the second thing I'd single out is this Climate Disclosure Task Force led by Michael Bloomberg, Mary Shapiro on it. It's published, as the Minister said, its first scoping report, hopes to produce a report by the end of the year. That, I think, is an enormous step forward. And that, for me, is the real change of perception in how financial stability comes through and how we should allow market mechanisms and the financial system itself to deal with the risks. I was going to talk a little bit about green finance and a project in the Bank of England to think long-term about how climate change might affect our objectives of monetary and financial stability. But I think I've gone on for long enough. Let me stop there.
Boris, you've been a leading natural resource science economist, if I've got the sequencing right. Shows that I'm not somebody who deals with these issues correctly, usually. And you've been a lead negotiator for the United States in climate discussions. You've been in the discussions all the way from Kyoto to now. You've been in the Treasury, you've been in the Congress, you've been in the White House. You have a lot to offer to this discussion, and we'd really like, and you've heard what the earlier panelists have said. So first of all, what is your view on the issues as laid out by them? Secondly, what do you think are the opportunities and risks in this discussion? And what's the role of public and private finances? So that's a lot of questions, all of them for you.
Well, thank you very much, and I want to thank the Toronto Centre for organizing this discussion. And I fully endorse this intersection of the financial stability and regulating community with the climate policy community, which I've been a part of for a long time. So I agree completely. This discussion is long overdue, and I really welcome this dialogue. And I'd like to start with the framework that the Bank of England has laid out with the physical risks, the liability risks, and the transition risks. I think that's an extremely useful framework for thinking about disclosure, thinking about risk, and the policy implications of those. Let's talk about physical risks for a second. These are very idiosyncratic. They're going to depend a lot on a particular firm's location and the potential for climatic disruptions and their kinds of operations. Some of these are sort of predictable. If you have a chemical plant in a low-lying area in Louisiana, you're going to be subject to sea level rise, you're going to be subject to storm surge and hurricanes. And some of these, we have some sense of how to predict. But there are other things that could be real wild cards. I mean, suppose a vector-borne disease, the Zika virus, takes hold in Louisiana and your workforce abandons your firm because they don't want their family subject to these conditions. All kinds of weird things can happen. So thinking through, well, what's the right kind of disclosure structure for that? I don't even know how you would standardize that, right? Because it's so idiosyncratic. But we do need to think through it. Some of the policy implications are subnational. It's going to be about land use or all sorts of other infrastructure investments that are going to be subnational in nature. So that, I think, is a whole research agenda right there. The liability risks, I think, are emerging. I don't know what to think about these investigations of firms, about their disclosures, and what that really means for the actual liability. Certainly in the U.S., I don't know what our tort system's going to think of this. But so we've got lots to think through on that. I want to talk about transition risks because I think it's really important for the community of economic ministers, finance ministers, central bankers, regulators to really, I think, play a leadership role. Serious climate policy is economic policy by definition. And I think that the leaders in these communities really should be playing an active role in saying sensible things about climate policy design. And maybe if you're not elected, that gives you more scope to say sensible things. When we talk about transition risks, some of these are not risks in a sense that they're almost foregone conclusions. We know what the projections for the coal industry are in any kind of serious, cost-effective climate policy scenario. And so if you know something's coming, the better you can plan for it, then you're going to minimize the damages both to the macroeconomy and to these local economies. I was in West Virginia last week, and we're looking at a Great Depression in some counties that are coal producing. And so we need to think about the distributional outcomes of these policies as well as the macroeconomic outcomes. And what about the potential for fiscal crises in some of these local governments that have lost their entire tax base, which was based on extractive mineral taxes? So I want to kind of put that sort of agenda out there. And I would say in terms of disclosure, you know, it's something to say, oh, well, everybody should just report their carbon footprint. But risk is not really well captured solely by a carbon footprint because it depends on your carbon footprint relative to your competitors, relative to the substitutes for your goods and services, relative to demand for your product. And I'll just give you an example. Suppose I operate a rail company and I'm very energy efficient. I look great from a carbon footprint standpoint, but what if much of what I haul is coal, right? My business model is under significant threat, and that won't be reflected simply in my carbon footprint. So the question arises, what kinds of disclosure procedures, what methodologies, how can you standardize this? And then what are the policy implications of these kinds of potential disruptions to companies' business models? And I would say there are a few things that come to mind. One certainly is the idea of shadow pricing and developing methodologies where companies can say, look, I'm allocating my capital not just according to projected energy prices, but energy prices amplified by the carbon intensity of those resources. And until we have a proper price on carbon, shadow pricing is the best way to anticipate a low carbon future in a systematic, economically sound way. But right now, there's no standard methodologies for doing that. And so I think this is a role for regulators and investors to ask for this kind of methodological development and facilitate that as best they can. I also think regulators are in a place to advocate for low shock policies. Like, we know that if carbon prices or equivalent measures are predictable, transparent, you can turn over your capital stock in a much more efficient way than if you're subject to volatile policies and regulatory uncertainty and all manner of fluctuations in ambition. So I think that is certainly a message that the financial stability community can convey, the importance of that sort of predictability and avoiding distortions in trade and investment, the value of harmonizing policies across countries or establishing, say, floor prices on carbon or common methodologies for identifying taxable or regulated entities, or other kinds of harmonization that I think could make the future of climate policy much smoother in its deployment. And we've done research. We have a paper called Expecting the Unexpected, where we look at the propagation of macroeconomic shocks and how they differ across different kinds of climate policy regimes internationally. And I think there are some lessons in that kind of research that that could be brought to bear. So I'll conclude there.
Thank you. I think you make a couple of very interesting points. One about to look at these not as risks but as known outcomes. So the way we look at these risks have to be it's supposed to be a totally different approach that we take. And the other point which you made about the having the appropriate methodology for the disclosure to be meaningful. And I think that's a point which I'd like to follow up on a little bit. The minister talked about the importance of disclosure and the work which is going on. You mentioned the tectonic transition shifts which we are likely to undergo, and again the role of disclosure, which is again a theme which is picked up both by Governor Inglis as well as by Governor Cunliffe. So let me get your take on two issues. One, how do you see the efforts which are ongoing in disclosure? How do you see them as being meaningful without an appropriate methodology, including, for instance, the shadow pricing issues which were referred to by Dr. Morris? And a related question, and we know that there have been lots of disclosure initiatives earlier, the one which is now being undertaken, how do we make sure that this is going to be mainstreamed and become something which goes beyond being voluntary and just being adopted by the members of the Financial Stability Board, for instance? So let me start with you, Doctor.
Wonderful question. I think the disclosure movement, if I could call it that, though that's probably not language that governors usually use when they describe this. The disclosure movement is important, very important, not just for standardization and for getting the information out there. It's because it's taking place in all kinds of boardrooms now. And we've become increasingly aware that as we get inquiries about what expectations for the international system changes from various kinds of companies, various kinds of investors. I used to go to investment conferences and talk about this and get blank stares and, oh, isn't that nice? The UN is talking about climate change. Now we get a list of 26 questions about what to expect on international decision making on all these things, which proves to me investors and boards of directors are trying to really wrestle with this in the privacy of their boardrooms. And that's good, but I think the Disclosure Task Force is important because it starts to bring it a bit more out in the open, it starts to standardize it. So information isn't the magic, the silver bullet for all of this, but it is the major first step. But I would just add one piece to this. We're talking about the marketplace and the discontinuities that can happen in the marketplace. There is a political marketplace too, and the discontinuities and the chances for political discontinuities are even greater than the market discontinuities. The minister has left, so I will say that in Canada we had a political market discontinuity. The shift on climate policy was fairly dramatic. We can expect that there will be fairly dramatic shifts in various directions in various countries, but it is really quite important that the debate we were having in Canada, with Canada, a year ago is totally different than what we see today. And those political discontinuities the potential for them is much greater. Sir John and I are both survivors of the climate meetings in Copenhagen in 2009.
I was going to fess up to that.
Well, survive is a relative term. The bottom line is back then, one of the problems with Copenhagen was a lot of leaders converged on Copenhagen and they didn't quite yet know what they were talking about. They knew this was an important subject. They knew they should show up, but they were not prepared. They didn't know what their own economies looked like. They didn't know what their own exposures were. They didn't know what they could do about it. In Paris, it was exactly the opposite. Head of state after head of state came to the microphone, and you could be forgiven if you thought, these guys actually know what they're talking about. And it was fascinating to me. I was sitting there listening to these different leaders and saying, in Copenhagen, you could probably have said, one hand or maybe two hands worth of leaders could actually get off their talking points and talk about climate change. In Paris, you would need lots of hands and lots of toes of lots of people on the stage to count the number of leaders who could talk about climate change off their talking points. That shows this is now politically relevant in a lot of countries, and not just small vulnerable countries, but in large emitting countries. So I would say that we need to look at the political marketplace and the potential for discontinuities there, even as we're looking at the potential for discontinuities in the financial and the real economy marketplaces.
On this issue of disclosure, it's just too early to tell what's going to come out of it. But if we don't give it a try, then we're not going to get anywhere at all. And I have had the great fortune during my professional life to start various projects where we basically started with a blank sheet of paper. And 5 years later, 10 years later, you realize that you've gone through consecutive rounds of learning by doing, but that's the only way to move things, because if you want to do it perfectly from the beginning, then nothing is going to happen, because then the whole thing seems to be so hard to do, so you never even start. And when it comes to disclosure, we're going to have to do it probably over and over again until we converge on something that seems to be reasonable. If we get to that point, which I think will happen, then we have already mastered how you follow up global agreements, in the sense that the fund and the bank, they have mastered this thing of sending 5 people on a mission to wherever for a couple of weeks, taking a look at what people are doing. And then using a process of, to be blunt, naming and shaming, if you have signed on the dotted line, but you did not really do anything except signing on the dotted line, so there's nothing there. And that technology is, how to do this is readily available, because it has been used for other purposes many, many times in the past. So that usually makes it possible to move things. The hard part in all of this, when it comes to dealing with these types of issues from a financial sector perspective, is that I picked 2 examples that were super micro, because that makes it easier to sort of understand what we're talking about. But one of the issues which is hard to deal with when you look at various phenomena from a financial sector perspective is how to deal with what we call non-diversifiable risk, systemic risk, because it doesn't really pay for individual actors to deal with systemic risk, because you're so small, so you might as well ignore it, either because you say, if I go bankrupt, everybody else is going to go bankrupt, or if I try to change things, I'm such a small player, so it doesn't really matter, so the whole thing is going to be a problem anyway. And this is where you actually need some kind of, over time usually, some kind of public sector intervention of sorts, because it doesn't always pay on the private sector side to take a long-term view, so somebody else actually has to deal with that. And that creates all sorts of very, very difficult issues when you think about these things, because that really means that you need to think hard about what kind of a risk-adjusted discount rate should I use when I think about these types of projects. And it's very, very hard to pin a number on that when you talk about things that might or might not happen 10 years or 20 years from now. But there's no other way but to just try to do it as best as we can, because if all of us ignore it, then we know that we're going to be stuck with a systemic risk in one form or the other eventually at some time in the future, and that will probably hurt everybody.
A couple of points on your 2 questions. I don't know that the disclosure task force will get us to a agreed methodology for shadow pricing, etc. But I think Stefan's point about it being a platform for enabling people to assess risk, at least to the first stage, is very important. And one of the important things about it is there are lots and lots of different ways of measuring your exposure to this risk out there at the moment. They've come from different vectors. Some have come from the kind of sort of green asset side. Some have come from NGOs. And the first problem is there's no consistency. So if you have something which is backed by the authorities in the FSB and the task force is interesting, it's not being led by regulators, it's being led by the producers of information and the consumers of information, with the consumer saying, what do I need to make a judgment about your company? If you have that and we have some consistency, we're there. And they're thinking about the principles of consistency, comparability. So how do the 2 train companies report? And how do they allow an analyst who is advising investors then to compile a league table of the risks that these different companies are. And analysts are very good at doing that and looking at underlying business models, looking at best in class, but they need the information to get underneath that. And it's important as well that this is forward-looking. I really endorse that. So looking backwards, what did I do last year and what's my footprint been in 2015 doesn't really help you think about risk going forward. And the task force is looking to try and come up with a standard that companies can report on forward-looking about their risk, again, to enable the analytical community to get there. So it may not be it gets to the bottom of everything, but it should take us a long way from a backward-looking reporting on very different standards to something going forward. And the second question is, well, it's great you've got a task force, but how are you going to make it sort of be implemented? I wasn't going to mention Copenhagen. I try not to.
You were there. I remember.
I certainly was there, and it made a lasting impression on me. But just 2 points about this. And this is not because I think if you like, the climate policy world has moved on a long way from that, as you said. But this community around financial stability and regulatory risk has been dealing with cross-border problems since the 1930s. Okay, we know about spillovers and we know we're all interdependent. We forget sometimes. We had a bad lesson. I had to relearn it again in 2008-9. But this is a community that is used to working together and has cooperative mechanisms, the Basel Committee, through the BIS, through IOSCO, through the Fsb. It's a community that's used to talking to each other and to some extent trusting each other on standards. It doesn't normally go for hard law, which is sometimes where the UNFCCC and whatever may have fallen down in trying to get hard and binding limits. It goes for standards, and they are often observed to 90% or 85%, but it's moved forward a long way, and it has that habit of cooperation and trust and just frequent reminders, sometimes too frequent, that we're all in it together. So when that community gets behind something, most of that something normally happens, if I can put it that way. And that's one of the reasons why I'm confident. And the market is used to following the signals from the regulators, provided it's pushing them in a direction they understand the reason for. So that's why I'm confident, actually, that there's quite a history kind of behind the way we do these things. As Stefan says, we have technology for following up and the like. I'm not saying it's perfect, it isn't. But in global governance terms, it actually has proved kind of relatively effective.
Well, thank you. And I think maybe we can also come to an agreement here that we won't refer to Copenhagen anymore.
Poor Denmark. Copenhagen's a beautiful city.
Yeah. So if just staying with you, Governor Cunliffe, can we talk a little bit about the issue which you mentioned earlier, which is the monetary and financial stability implications of the green finance movement, and where do you think more focus needs to be laid both by public policy as well as by financial market participants?
And I should say the Chinese G20 presidency has taken a leadership role on green finance. So this sits within green finance. It's broader for them than just climate related, but clearly one is a very large subset of the other. And there's a working group under the G20 that the Bank of England is co-chairing. I think it's best when standards come from markets as far as they can, but they need help from the authorities. You have coordination issues, and again, there are lots of different standards out there for green bonds and the like. But I think it's the point. Oh, sorry, I've lost mine. Was that completely unaudible to the people at the back? Oh, we didn't miss much. It's fine. I think there's two parts to this. One is to push now for just more standard terms that market participants can use, and just try and guide the market to that, because there are, again, a variety of forms. You need to try and coalesce around some standards. The other point, though, is maybe more important. It's tended to be a niche, if I can put it that way. As you say, it was early days in this. And what you really want to do is, as far as possible, to have the terms on which green market-related green finance, green bonds or whatever, are traded as close as possible to all other forms of finance, but just with the standardization, a bit more standardization around the things that make this, the information that you need for this particular type of investment. And other niches have kind of, in the past, have started that way, and then they've been assimilated into, if I could put it, broader financial markets. And I think that's the challenge, is to have something which actually can become part of the financial system rather than a speciality type of instrument. And they're actually, that group is well advanced on producing a report, so that there's progress being made.
Well, the hard part is always when you start new markets to actually get them going, because you have somebody, you have to have enough companies, individuals involved in, and who have a willingness to issue the debt, and then you have to convince a large group of buyers that they actually should buy this stuff. And to do that, you have to, in some sense, set the preconditions right in terms of standards, legal frameworks, and things like that. But that's just a necessary condition. It's not always a sufficient to get the whole thing going, because that eventually actually takes thousands and thousands of people willing to act, and usually it takes a while to actually build on that. Eventually new markets always kind of come into existence, but many times it actually takes much longer than one would expect, and you cannot really ex ante say that this is going to happen in the following way in that particular financial center. That you just don't know. But you can sort of participate in this work and do the, if I call it, do the technical background work in such a way that things don't stall. But beyond that, it's really going to be up to the market participants to say, okay, this is not a bad idea. I would like to participate in this. But then how that happens and with what pace, that you just cannot determine, because that's up to the market participants.
Okay, so I've just got to give a small and rather unusual historical example of this. Before the euro was launched, it was called the ECU. You have to remember, the name got changed just beforehand. And people tried to start a market from the early 90s in ECU bonds, ECU financing. The euro didn't exist, but you could put together the currencies and you could trade it. And it started in London, and you trade it. It was a niche, but it kind of moved to a certain point. And then the German government decided that the word ECU just sounded too French. No, I'm serious. And it wouldn't fly in Germany as the ECU, and it had to be called the Euro. And initially people said, oh, don't be so silly. But when Berlin wants something, they normally get it if they really want it. And it was changed. And all of these bonds that had been ECU bonds, people started to say, what do I hold? And they'd never really looked at the term sheet, and they all had different term sheets, and they all had very different definitions of what the ECU was. And now the market panicked because it said, it was getting going a little bit, and they said, well, these are not comparable instruments, and the law under which they were being dealt with is very different. And they took the advantage of the name change to actually do a continuity of contract. That had to be done because people didn't know, I hold an ECU, and is it going to be paid back in a euro or not? But actually they took the opportunity to standardise terms in the way of thinking about it, which then led the market to really move ahead in the years before the euro was created. And it's an example of how you can go so far in a niche with everyone doing their own thing. But then when the market can actually, I'm not suggesting we change green to brown, but it's an example of how these things take off. But you need the standards, sorry.
So just let me support you on that, because you cannot touch financial instruments. Financial instruments only exists in the heads of people via the legal contracts that you put together and in computers. And if you don't agree on what you have created so that people have different things in their heads, then you just can't trade things. So you have to have a common understanding of what it is that you're doing. And without that, things never take off because it's going to be one-on-ones. Turnover is going to be extremely low. You can never trade out of the position. You know that it's going to be buy and hold and things like that. So here, all the traditional tools and all the things that you need to think about when you create markets are basically the same. Here, the circumstances are different. The background is different. The information you need to have to make these things happen is different. But in terms of the technology available, it's pretty much the same, provided that you are willing to go through various processes of standardization. But without that standardization, you can never engineer orderly transfers of ownership titles, if I call it that. And that's the key to creating markets.
So, Dr. Morris, would you agree that the eco-bond experience can be shared with the eco-bond experience?
Well, I think it illustrates Dean Orr's comment earlier about political volatility and what that does to markets and the actual outcomes of these various instruments. And I wanted to go back to your example of Tesla. So one of the keys to the business model of Tesla is the tax credit for electric vehicles of $7,500. And the fact that electric vehicle manufacturers can sell compliance credits for corporate average fuel economy standards into the market to traditional automakers who then can sell more SUVs. So that right there is a policy risk, a political risk for the business model of the electric vehicles. So it can go all different directions, right? So the policies can become more stringent, but if we had, let's say we had a carbon tax in the United States, there might be a movement to suspend or end the tax credits for various other, green technologies. So there are, look no further than the Australian carbon tax to see the risks of political volatility. And I just want to go back to my earlier point that it is so important, I think, for leaders to hear from the financial stability community about the importance of trying to mitigate that political risk. I realize, democracies are unpredictable, and I think we see that now in the United States. But but hearing that there can be a true economic cost to that volatility, I think can maybe raise the discourse a little bit. And I can't resist talking about Copenhagen for a second. So we modeled the outcomes of the Copenhagen Accord in our global computable general equilibrium model. And one of the things we learned is about who is it that is affected by countries meeting their commitments. And it turned out that most countries, when you go to these negotiations, they're all fixated about what those commitments mean to their own economy. But the actual largest predicted macroeconomic outcome was on fossil fuel exporters, some of whom didn't even have obligations under the Copenhagen Accord. So understanding the systemic risks from those macroeconomic spillovers when other countries are introducing climate policy, I think is an important part of the anticipation.
I was going to say something slightly controversial, which is a personal view and not the view of the Bank of, well, it may be the Bank of England, but I've never really asked them. It's not just important to get policies consistent, you have to get them right. If you look at the history of carbon trading in the European Union, you actually have, there's a lot of learning by doing, but you see a lot of, I think it's the clip, not me. You see an awful lot of spikes and collapses in the carbon price. And the point about carbon trading, so from an economist's point of view, it's a much more efficient way to deal with things than a tax, to have trading. But of course, somebody has to put scarcity into the market, which is what the public policy actors do by limiting the amount of carbon permits. So this now starts to look a little bit like central banking. Okay, you are controlling the supply of something to change the price. Okay, and you're using the supply of it price. Now, central banks do that on a very regular basis, and we know the economy is changing all the time. So we don't. I mean, nowadays we tend to target inflation rather than monetary aggregates. But there's a long history of central banking, which was about changing the money supply to fit the economy, and trying to keep, if you like, the two growing together, and the level of scarcity in the same place. So we do it now by changing the price. The European system reset those carbon budgets, I think, every 5 years. And of course, if you get a technological development, the price of carbon will just collapse, because everybody could suddenly. So in order to make a carbon trading system work and not behave unpredictably, to my mind, you need a lot more economics behind it to actually, as technology, we hope, enables people to be more efficient, but you still have further to go. You want to be increasing the scarcity in order to get the incentive effect. And I don't think, bluntly, I don't think that was ever really properly thought through in Europe before we launched it. London became a centre of carbon trading. There still is trading there. But actually, a lot of the market fell into disrepute when, for a number of reasons to do with allowances and the like, the bottom just fell out of it and the like. So if we're going to use economic policies and economic tools, we don't just have to be consistent, we actually have to construct them properly. And sometimes, travelling in hope is maybe not the best way to create markets.
John, if I could just pick up on that, I think getting the policy right and learning from your mistakes. I think a lot of the carbon market development around the world, it has studied very carefully the mistakes of the Europeans. So that early pioneer spirit, while welcome, didn't produce the results that either Europe or the world hoped for. But now you see what's happening in China with the commitment to go to a nationwide carbon market and carbon pricing system by 2017, extremely ambitious. This could dramatically shape global carbon markets and the new perceptions of what the value of carbon pricing. And so while we've all studied kind of the historic examples and we still think of this as kind of a European phenomenon, it is most certainly not just a European phenomenon anymore. And what's happening at the state and local level in the United States and different carbon markets here, and pricing development within the private sector here. So you have these other poles in the United States, in China, that will start to shift what the carbon pricing and carbon trading markets look like. And I think that's extremely important to recognize. Just like we aren't stuck in time with Copenhagen, we're not stuck in time with kind of previous generation European carbon markets. There is an evolution here.
Thank you. You opened up a whole new sort of Pandora's box with this discussion on pricing. So I believe we should take some questions from the audience at this stage, because we would otherwise run out of time pretty soon. So please identify yourself, and if you have a question directed at a specific panelist, please do so. But otherwise, I will employ my discretion. Let me start with you.
Yes, Alden Meyer from Union of Concerned Scientists. Thank you. This is a fascinating discussion. You've been focusing on. Can you come to the mic? Oh.
There's one here.
Alden Meyer, Union of Concerned Scientists. Thank you for this. A lot of the discussion of the Financial Disclosure Task Force is around the micro level. It's the consumers and producers of information at the firm level to inform shareholder decisions and risks. I would like to hear from the panelists what is going to happen with those recommendations at the G20, because I think the significant thing here is this has been commissioned by the G20 through the FSB. It's not Ceres producing it or UCS producing it or Carbon Tracker. It's actually a mainstream government-driven kind of process. What will happen there? But I'd also like to hear about the macro level, which is that despite what Bob said about changes in business models, collectively, the business models of the world's corporations are not consistent with a sustainable business model for the planet, as will be highlighted by the Intergovernmental Panel on Climate Change special report in 2018 on the 1.5 degree scenario. So how do you deal with the macro sort of carbon asset repricing challenge, which is we need to let the air out of the bubble, but not all at once and have it pop, creating things that might make 2008, 2009 look like child's play, but we have to let it out in a sustainable way that reprices assets over time, consistent with the radical task it's going to take to get us in a 1.5 degree pathway through to 2050. So if you can comment on the micro implications for the G20 and the macro, sort of how the FSB or the G20 are thinking about the macro side of the carbon repricing challenge.
Thank you. Let's take another couple of questions then, because otherwise we will run out of time. So let's, yes, of course.
Thank you very much. Very interesting panel. Nick Robbins from the UNEP inquiry. Particularly interesting, maybe sort of thinking forward about what sort of new generation of risk analytics we might need to process some of the disclosure that's coming into the markets, particularly in terms of how we ensure that some of these disruptive scenarios are better understood both by financial institutions and also by the official sector. People who've been talking about sort of new types of stress testing tools. Welcome your reflections. Thank you.
Thank you.
Barbara Matthews, newly affiliated with KPMG's internal think tank, Regulatory Center of Excellence. At a personal level, I find it very refreshing that the regulatory policy system is viewed with so much confidence. That, and many of us have been veterans of points in time when everyone knew what the right answer was. After the Latin American debt crisis or derivatives or credit risk models, I'm glad we've got confidence in the regulators again. My question is related to stress testing. So much of the Prudential system is focused on a normal distribution and VaR-based models. And while the outcome on climate change may not be in doubt, as Stefan and Sir John noted, the impact on financial institutions will certainly not be evenly distributed. And that's a very important technical challenge that merits a great deal more thinking. My guess is we've only just scratched the surface, but I look forward to reading more about it and hearing what you have to say.
One more, and then we...
Slava Mason, World Bank Treasury. I had a couple of actually, but one very short. Can you hear me? One aspect of decarbonization that one can think of is positive impact on health, actually, globally. So, what are your thoughts on this? And one can argue that we will get better health, we'll live longer, which will have implications, echoing the just prior question, for some financial institutions, right? Unevenly. Insurance companies will probably do better. Pension plans probably not, so because we will live longer. So just curious about your thoughts on this. And another question was on, actually more like a suggestion. We have certain reporting requirements already in place. Like we have calorie counts, on everything. We have Energy Star ratings on certain things. We have same type of reporting on cars, right? What do you think of for better disclosure and awareness of adding carbon counts to those?
Okay, thank you. And we'll take those two questions, and then that's it. And then we'll complete, because we're running out of time here.
Thank you very much. George Brady with the Institute of International Finance, but until recently with the IAIS. My question is specific to the insurance sector, which obviously plays a key role in this, and it goes to the question of whether monetary policy or macro-prudential policy will take account of the key role that insurers play in a world where there's increasing frequency and severity of natural disasters and serious illness and disease spreading around the world, and taking note of the impact of the current monetary policy on insurers. Thank you.
Thank you.
Andrea Corcoran, Toronto Centre Securities Advisory Board. And I want to ask about what I would call the systemic elephant in the room from a stability perspective. And that is that the impact of climate change policy and the mitigations on the fossil fuel exporting countries, many of which have budgets that depend anywhere from 40 to 80% on their extractive businesses.
Thank you. So we have 6 questions for the panel, and I'm going to just go around so that you can all have a go at it. We had the question on the micro and macro impacts related to disclosure, the new generation of risk analytics, the impact on health, possibly a carbon rating, the monetary and macro policy implications for macro prudential policy implications for insurance, and finally the one on the countries with large carbon budgets in a certain sense. How do we look at them differently? And did I miss any? No. So let me start with you, Dean.
Okay, I'll try to address a couple of these quickly. I think the health question is an extremely important one, not only because the nexus of health to climate is very important for good policy making on climate, but it's also important for good policy making on health. And those arrows go both directions, and it has very big impacts on things, including insurance. But I think the point made about pension funds is fundamental. I think the discussions that are starting among pension funds around the world, and just starting, I mean, the conversations have been going for a while, but pension funds, if you talk about a business model in need of a revamp, here we have it. And I think a lot of pension funds have been looking at different parts of these equations, but the fact that if we get this right on climate change, it impacts longevity and the like, I think is actually quite important. I do want to follow up on this issue of the insurance sector, because I think it's been one of the key players that has been really at the margins of these discussions, and is starting to move to the center of these discussions. 3 weeks from now in Washington, D.C., we will have a Climate Action 2016 summit, which will bring together a number of the coalitions around key parts of the climate equation. One of those sectors that will be heavily represented will be the insurance sector. This would not have been the case 2, 3, 4 years ago when we tried to invite insurance companies into the discussion. 4 and 5 years ago, there was great trepidation. Now insurance industry sees its future at stake. They're really entering both the climate risk side, but also the climate solution side, because they're huge investors and placing lots of money, as well as getting hit on the other side of the business. So I do think the insurance industry is central to a lot of this. Finally, on the fossil fuel exporting countries, getting prices right on fossil fuels and getting the subsidies issue addressed is really central. The G20 since Pittsburgh, and I watched the bloody discussions in Pittsburgh around eliminating fossil fuel subsidies. This has been evolving slowly within the G20. It's been kind of 1 step forward, 2 steps back, and vice versa. The countries that have started to wrap their arms around fossil fuel subsidies have seen some very interesting things happen, including countries as challenged on this front as Nigeria, when they eliminated some of the fossil fuel subsidies and dedicated that money to maternal and child health. They saw not only, let's call it positive movement on the fossil fuel side, but saw direct impacts and measurable impacts on improving maternal and child health. That creates a political coalition that can sustain a change in your fossil fuel subsidies that normally is just all pain for a government. So starting to look at the range of experiences governments have had at getting rid of fossil fuel subsidies, but then allocating that money in ways that makes it sustainable. This is a whole new, let's call it industry, that governments need to study each other's experiences and advance, because that getting fossil fuels priced right and getting other public goods provided in that process is really huge. And I just wanted, since Nick Robbins asked a question, I did just want to do a shout out for the report that he didn't mention, but the report that the UNEP inquiry did, The Financial System We Need, is worth reading. So you didn't ask about it, but I'm going to give you a public shout out anyway.
I can't answer all the questions, Joe, just a few of them. Then next steps after the Fsb project. Hard to tell, but what is likely to happen is kind of the following in flow terms. Eventually, after some discussions, we get to a global agreement on what these reporting requirements are supposed to look like. Then you get a group of countries, jurisdictions to say, we accept this. We accept that this is what we are prepared to tell our corporations, banks, companies, whoever is involved in this at home. And we also accept that somebody is going to show up 3 years from now or 5 years from now to check on us, to make sure that this is actually happening. And this is exactly what I referred to earlier when I said that the technology, how to do this, is already available in terms of how you actually keep track of what is going on. And it has been used in many, many instances in the past. It will take 5 years, 10 years to do 80–90% of the world in terms of countries that matter to do this, and then you just take it from there and keep going. And then you make adjustments along the way, because you will never get this right from the beginning. So once in a while you have to get back to FSB or somebody else and say, this works, this did not work at all, let's make a few adjustments. But that's a likely outcome of this project. Insurance and macroprudential issues, it's hard to get a good grip on this, and I think what has happened in this country is a good example, because those who read the newspapers realize that all insurance are not happy about getting involved in macroprudential issues and resist that. And eventually it's going to happen in one way or the other, because insurance is important, and they're the ones that are going to go bust if you don't price these risks properly. So that for sure is an issue which will stay alive for, I think, a long, long time to come. And the third issue, which was already mentioned, oil subsidies. The answer is very simple: get rid of them.
Amen.
Okay, I won't answer the question about G20. I think Stefan's answered that. I'll answer the micro-macro. So micro perspective, there's investor protection, all that. From a financial stability point of view, that's not my concern. I have two concerns. One is a sudden repricing. So everybody has a certain view of risk, or doesn't have a view of risk, and then something happens, one of Robert spikes, and you get a sudden repricing. So from a macro financial stability point of view, that's really what you're worried about. A whole asset class suddenly gets repriced. There's a loss of confidence, and that can transmit through the financial system. And to me, that's what allowing different agents in the market to take different views on risk. It's about letting the air out of one view of risk, or, if you like, not even thinking about it, and having people adjust slowly. And that's really how you kind of let the air out. You let analysts reach views. You provide the information for that, and then you don't have everybody on one side of something when it changes. It is quite important, though, if the market is going to work out the public policy reaction function, that the politicians are credible, and we deal with the time consistency problem. I wasn't at Paris, but Paris, as Robert said, was a major step forward. But they have to continue to deliver, and there is scepticism in the market as to whether the public authorities really can get their act together on this, and whether they should believe what's been said, because it depends on politicians delivering. And if they don't deliver, then of course it'll be much more difficult. The information won't help, because people have to look at the information and say, and if the public policy framework develops in the way that people have said it will develop in order to prevent a certain outcome, I can now take a view on this asset. If actually politicians disappoint and continue to disappoint, then information in the market won't do that job. So it's kind of incumbent on the political system to do that. And just two other quick points. I'm glad I've convinced people to have confidence in the regulators. As a regulator, I have to have confidence in the regulators. What I was trying to say was not that regulation of the financial system has always worked terrifically well. And actually I made the point that we've had a rather large recent example of when coordination didn't work well, and when we didn't have standards. I was just trying to make the point that we have been dealing with those issues on a repeated way for many years. And when this community does have ways of dealing with it, it sometimes forgets how to do it. the climate change community has not dealt with the climate crisis yet. I mean, that's the whole difficulty of reaching agreement, in that you're reaching agreement for something which is in the future and hasn't yet happened, whereas we deal with repeated crises. And I was just making the point, we have got kind of fairly well-worn machinery for that. We've had to have it. It doesn't always work well, but it can generate international standards. And as Stefan said, it can get to their implementation. And finally, on insurance, I'd understood the question to mean something else, which was we need an insurance industry to mitigate and the impact of climate change and also to act as a kind of economic force to counteract. And if we keep interest rates so low and insurers can't make any money and they're being killed by low interest rates, we won't have the insurance industry. So have central banks taken into account when they set interest rates that they're damaging the insurance industry and therefore they're damaging. I thought that was the import of the question. And my answer is yes, we do understand the impact of low interest rates, and from a financial stability point of view, it's something we worry about or whatever. But we also have to make trade-offs about the world economy and try and preventing it to getting into a bad place, and you can have multiple equilibria here. So these things kind of they get weighed in the policy decision. But yeah, the impact of low interest rates and the stress on insurance companies, for what it's worth, is understood.
So I want to come back to this idea of stress testing. And there are a number of coal companies in bankruptcy now that wish they had stress tested the price of coal in their acquisition of metallurgical coal companies. And there are probably a number of state governments that wish they had stress tested this when they allowed these coal companies to self-bond their mine reclamation liabilities. So we're probably looking at billions of dollars of unfunded reclamation liabilities because those stress tests were not properly conducted in a whole chain of events. So I don't know exactly what the lesson is from that, but don't do it again is probably at the top. How do we let the air out of the carbon asset situation? So I think the key thing is that people invest in long life capital according to expected prices, not statutory prices. So the more we can match the statutory price and the expected price and keep those consistent and predictable, in my view, the better. That means having a price that's credible and not just trying to speculate as to what our climate policy is going to be. And that's a note to the United States right there. That's why I happen to prefer the idea of a carbon excise tax, because you can keep that more transparent and then you don't have the fluctuations that you were talking about in a trading market, although there are lots of pros and cons to both approaches. And then when you do set a price that's conceivably consistent with the willingness to pay, so that people don't discount the probability that it'll be persisting, right? So it's getting that sweet spot of ambition, but not killing consensus with too much ambition and then undermining those expected prices. So I think time will tell, but we may well have fits and starts, but that starts with a start.
Well, thank you very much. It was my intention to try and summarize your remarks, but I think we've run out of time. And we're also running out of time for the climate change dialogue as well. I think that's one certainly message which we can take from here. What's been very good is that there's been an exchange and a better understanding of the perceptions and the positions of both people who are engaged in the climate change discussions and those who are engaged in financial stability for a livelihood. And I think continuing with this dialogue further will probably be the best way to go. And there are many complexities which we still have to try and resolve. And Stefan, you mentioned the problem of which I think Governor Carney has articulated as this is not just a tragedy of the commons but a tragedy of the horizons, which means you have to be able to really factor it into your thinking and the public policy cycle itself. But again, as I said, to end with this very small anecdote, there's a lot at stake here, and that could be our pensions. And the reason why I say that is because last week, and I mentioned that to you, Dr. Morris, a court in Oregon finally allowed children the age of 8 to sue the federal government for not having done enough to control the effects of climate change. So with that little warning, let me end this discussion today.